Welcome back to The Explainer. It's July 28th, 2026, and wow, global markets are going through some serious turbulence right now. We're looking at a landscape where, quite frankly, chip stocks are getting absolutely crushed, the crown for the world's most valuable company just changed hands, and a giant new digital payment network is officially getting off the ground. So in this Explainer, we're going to break down exactly what's happening, why it matters to you, and where the smart money is actually flowing amidst all this chaos.
Okay, let's dive straight into this. We're going to synthesize a mountain of news today into 4 distinct macro trends. We've got the great tech rotation, resolving corporate headaches, the platform wars, and how market infrastructure evolves. Before we wrap it all up with the bottom line.
Let's start with our first major shift. Number 1, the great tech rotation, moving from hardware monopolies to defensive spending.
To truly grasp the scale of what's happening here, you've got to wrap your head around this number, 90%. That is the global market share that ASML, the Netherlands-based tech giant, has basically held as a total monopoly in advanced lithography machines. And if you follow the space, you know lithography is the absolute most critical bottleneck in chip manufacturing. But suddenly, an exclusive report just revealed that a Shanghai-backed Chinese company has officially started mass production of their own domestic immersion DUV lithography machines. Now, sure, they're only targeting roughly 5 units this year from major foundries like SMIC, but man, the symbolic blow here is massive. It completely shatters the Western technology blockade. Think about it, if China can produce its own tools, ASML's revenue exposure to China faces an existential threat. And all that legislation like the US Congress's Match Act that was designed to block these exact sales, it essentially becomes obsolete before it even takes effect. The market reaction to this news was brutal. ASML plunged over 7%, SK Hynix crashed over 14%, and heavyweights like Nvidia and AMD took serious hits.
But here is where we see the actual rotation happen. While chip hardware was crashing, software stocks rallied hard. Google, Microsoft, Palantir, they all jumped up. The underlying logic here is pretty straightforward. More chip supply eventually means cheaper computing power, which naturally boosts software margins. And this brings us to a massive divergence in strategy. While practically everyone else has been burning billions, and I mean billions, to build massive AI data centers from scratch, Apple decided they'd rather just rent. At first, critics were saying Apple was totally falling behind in the AI race, right? But suddenly, that conservative approach to capital spending translates to lower risk and higher short-term profits.
And the market is heavily rewarding this defensive playbook. Just looking at the year-to-date stock growth for 2026, Apple has surged an impressive 24%, while Nvidia is sitting at just a 4% gain. Because of this exact shift, Apple has officially overtaken Nvidia, taking back the #1 market cap spot at $4.95 trillion compared to Nvidia's $4.77 trillion. Spending less has literally turned into a massive competitive advantage.
All right, moving on to our second macro trend. Number 2, resolving corporate headaches or paying a premium for certainty.
So we're seeing major consumer and media brands taking some really aggressive, sometimes painful steps to cut their losses and fix long-standing issues. And Wall Street, they are loving it. Take Johnson & Johnson, for example. They just dropped a massive legal bombshell, agreeing to pay $5.5 billion to settle roughly 69,000 lawsuits, claiming its baby powder caused cancer. Now, J&J continues to firmly deny all allegations, maintaining the product is totally safe and asbestos-free, but they are willing to pay this massive upfront cost just to turn the page and get back to focusing on developing medicines. Naturally, you'd probably think a $5.5 billion check would completely tank a stock, but actually shares jumped 2.3% pre-market. Why on earth would that happen? Because it represents a fixed, known cost. It effectively ends a decade of dark cloud uncertainty and wildly unpredictable jury trials. Investors are basically paying a premium to get that certainty.
And we're seeing a very similar appetite for decisive action over BuzzFeed. The digital media company just announced a pretty brutal 35% workforce reduction. That's roughly 180 employees under the new controlling ownership of media mogul Byron Allen. While it's going to cost them up to $8.5 million in one-time charges, the move aims to save roughly $30 million annually. Look, in the struggling digital media space right now, endless cash burn is public enemy #1. By aggressively cutting costs to establish a clear path to profitability and paving the way to eventually merge with Allen's Local Now service, the market absolutely cheered. It sent their shares rallying 4.4%.
But of course, fixing a corporate headache isn't always a smooth ride. Just look at the recent saga at Cracker Barrel. Last August, the company rolled out a new logo that removed their classic character. Well, that sparked an immediate and intense backlash from their traditional conservative customer base. Even Donald Trump posted on social media asking what happened to the brand. So the company quickly backpedaled and reverted to the old design. Fast forward to the present, CEO Julie Masino has announced she's stepping down, and veteran industry leader David Dino will be taking over on August 10th.
Now, following all that backlash, Masino told a conservative commentator that she felt she was, quote, fired by the American people. The market's reaction here definitely reflects a cautious wait-and-see approach. Shares actually fell nearly 3% on the news of her exit, mostly because sudden leadership changes often hint at deeper operational issues behind the scenes. Investors are just waiting to see if the new CEO can successfully win back that core demographic without alienating future growth. Let's transition over to our third trend, number 3, the platform wars, where we're looking at streaming synergies and super app dreams. The battle for digital dominance is really heating up, and we're seeing this stark contrast between safe, synergistic deals on one hand and highly ambitious, high-risk gambles on the other. On the safe side, we have a huge win-win in the streaming world. Google and Comcast just signed a multi-year deal to include the Peacock app directly inside YouTube Premium subscriptions starting in early 2027. What's wild here is seeing an old-school cable giant like Comcast acting as a synergistic lifeline to a very modern tech platform like YouTube. But honestly, it works perfectly. YouTube gets to lower its subscriber churn by offering a much better bundle, and Comcast gets access to a massive pool of brand new subscribers. Unsurprisingly, both stocks ticked up roughly 2%. Compare that to Elon Musk's rollout of X Money. This is a highly ambitious digital wallet launch, for sure, but it faces huge execution risks, serious regulatory warnings, and a highly skeptical market, which sent shares down 2.5%.
Let's take a closer look at X Money, though, because the feature set is actually quite robust. You've got a digital wallet, free peer-to-peer transfers, Visa debit cards, Apple Wallet integration, and a very attractive 6% yield for Premium Plus subscribers, all of which is FDIC insured via Cross River Bank. This is Musk's big bet to create an American version of WeChat, basically an everything app, combining social media and finance. The catch? Investors know that launching a fintech platform from scratch is incredibly expensive and heavily regulated. When lawmakers start publicly warning about the safety of user funds, Wall Street gets nervous. And with a U.S. senator already issuing a public warning, plus some brutal competition from established giants like PayPal and Venmo, the market is highly skeptical that this will generate meaningful revenue anytime soon.
Which brings us right to our fourth and final macro trend, number 4, market infrastructure evolves, looking at restructuring exactly how we trade. We're seeing some foundational changes in how money moves and trades behind the scenes. Now, what's really interesting here is how this perfectly captures a classic market mechanic happening today, arbitrage. Take the private equity firm Winchurch Capital. They just announced they're buying materials company Luxfer for $462.7 million in cash. They're offering exactly $17.37 per share, which is a sweet 31% premium over its previous trading price. Instantly, right at market open, the stock jumps to precisely that 17.37 level. Why? Because investors buy shares specifically to capture the spread between the current price and that confirmed buyout price. It's a textbook example of market mechanics at work.
But the absolute biggest infrastructure shift today comes from the CME Group. They've officially launched cash-settled single-stock futures on 55 major U.S. stocks. We're talking Apple, NVIDIA, and even SpaceX. These are going to trade on the Globex platform essentially 24/5. Guys, this is an absolute game changer. Just imagine reacting to overnight breaking news by trading Apple stock at 3 a.m. on a Wednesday. Previously, you could only trade U.S. single stocks during regular market hours, right? Now, Asian and European investors can react instantly to overnight news or macro events in real time. And unlike options, these have no time decay and they aren't affected by implied volatility, but they still offer that leverage traders want. Morgan Stanley analysts are already calling it one of the biggest retail growth catalysts of the entire year. CME stock is up 16% this month alone as Wall Street prices in the massive revenue stream they'll get from these new transaction fees.
Finally, number 5, the bottom line. Let's synthesize all of today's shifts.
We've covered a lot of ground today, right? From the foundries in Shanghai all the way to the trading floors in Chicago. So let's tie it all together so you know exactly what to take away from these massive shifts. Everything we've discussed today rests on 4 key market pillars. Number 1, we're seeing a hard, undeniable rotation out of high-risk AI chip plays as China's DUV breakthrough really cracks that Western monopoly narrative. Number 2, the market is heavily rewarding defensive tech spending. Apple overtook NVIDIA simply because their strategy of renting compute power instead of building massive data centers suddenly looks incredibly smart. Number 3, investors are paying a premium for corporate certainty. Whether it's J&J dropping billions to end their lawsuits or BuzzFeed making deep cuts to stop the cash bleed, the market wants known variables. And number 4, our market infrastructure is rapidly evolving into a 24/7 environment with CME's single stock futures completely reshaping how global investors access U.S. equities.
These structural shifts prove that the financial landscape is changing faster than ever before. As geopolitical hardware blockades start to crack and overnight futures trading makes global reactions practically instantaneous, we really have to ask ourselves, with 24/7 access to single-stock futures and the tectonic plates of tech monopolies shifting in real time, does Wall Street ever truly sleep anymore? Thank you so much for joining me for this explainer. I really hope this gave you a clear, actionable roadmap of the markets today. Keep learning, and I will catch you next time.